Good evening, students. Welcome back. We are connecting after some gap of time. Yes, very good evening, Soumya, Tanu. Yes, Almas, Krishna Shri. Wow. M.A. Sorry, again I forgot your name. Yes, good evening, Yash, Kirti, Sahil, Viplav, Anubhav, Rajveer, Somesh, Priyanshi, Astha, Priya. Same here, beta. Same here. Minu. Good evening, one and all. So, I hope you all are studying well and now you all are geared up for the subject, this particular subject, and also your other subjects of CA intermediate exams. So, before I start, as a ritual, I should say, we will take your queries. You may raise your queries pertaining to any question, either obviously this chapter is yet to be started, but if you have anything, you can pose me, or even if it is relating to any prior topics. And if something is not clear, we can have it for 5 minutes and then we will start. Yes, Harsh, Shagufta. Students, kindly let me know your queries. I would like to first address, clear your doubts, because now we are on the last leg of this particular subject. So I broadly feel there are 3 legs. The first leg is where you get acquainted with the subject with some basic topics, which includes the charging part, which includes the definition, which includes your residential status, exemptions. Then the second leg covers the computation, which will end at this topic, you can say so. And then the last leg, which comprises of the procedural part. So by now, you all would have covered the topics pertaining to all the 5 heads. You all would have covered the topic pertaining to the set off and carry forward of losses, the topic pertaining to clubbing of income, and this you can say is the last topic in the computation part. Obviously, there will be one more chapter where you will be dealing with the overall computation, but specific chapter wise, you can say this is the last part. Okay, so Asta has a question. Sir, in 55A, I want to ask if assessee claimed value on purchase and not on FMV, then also this section will apply. Okay, so basically you're talking about section 55A, if I'm not wrong, because there is some spacing. So I'm assuming you're asking for 55A, which is the capital gain section dealing with valuation. Am I right? Yes, beta. So you are asking, one second. You're asking if assessee claim value on purchase and not on FMV, then also this section will apply. See, I don't think that is the correct interpretation. Let me just open the act for you. I always prefer reading from the act, and I'm sure you all will also prefer reading from the act. Let me just open the act. I think my screen is not visible. Let me again reshare the entire screen. Yes. In the meantime, others may also type your queries, if any. So you said beta section 55A. So let us. What happened? Now see, what does the section says? Firstly, why this section is made, let us understand this. If you recall your topic of capital gain, you will find that in capital gain, in multiple sections, they have asked you to take the fair market value as the value for computing capital gain, which may be either in the full value, that is the sale price, or it may be in the cost of acquisition, right? So on either side, there are provision which ask you to take the fair market value as the respective value. But you asked for something relating to purchases. That is why I said, I don't think that is how the provision is, but we'll read together. So what does 55A says? With a view to ascertaining the FMV of a capital asset for the purpose of this chapter. So wherever in this whole chapter, fair market value is required, you will refer 55A. What does this say? The assessing officer may refer the valuation of the capital asset to a valuation officer. So what is the point? See, understand this. Had it been stamp value, you don't require this because stamp value is documented. It is easily provable whether the stamp value you have taken is right or wrong. But when it comes to fair market value is the most, what you can say, subjective value, because everybody may have a different assessment of that particular property. So that is why it is never sure what is the correct fair market value or whether the fair market value which you have taken in your computation is correct. Hence, this section says that wherever assessing officer, so you have filed your returns taking some fair market value. Now the assessing officer at the time of checking your returns or assessing your returns, he may refer your valuation to a specialized person called as the valuation officer. But when he can do so, for that there are conditions given in clause A, clause B. First, when he can do this, in a case where the value of asset as claimed by the assessee. So you have only claimed it in accordance with the estimated of a registered valuer. So already the value which you have taken, the fair market value, you have got it valued from a registered valuer. So it means your value has some authenticity. So when your value is already in accordance with some registered valuer, then what it says, if the assessing officer is of the opinion that the value so claimed is at variance with the fair market value. So you have already done a valuation, but your assessing officer still feels that there is some variation. Hence, he can go to the valuation officer case scenario 1. Case scenario 2 in any other case. So what is any other case? Your valuation is not done by a registered valuer. You have done casually. Casually means you have asked few people and they have said, okay, according to us, the market value of this should be 1 crore. So on that basis, you have taken 1 crore. Then what it says, in any other case, if the assessing officer is of the opinion. So now, when you have not done your valuation through a registered valuer, when can he do this valuation? When he is of the opinion that the fair market value of the asset exceeds the value of the asset as claimed by the assessee by more than such percentage of the value as so claimed or by more than such amount as may be prescribed. In short, they are saying we'll give you some percentage. Like if you remember, we already have that 110% rule. So already there some percentage is given. Similarly, here also, they say that some percentage or some amount will be prescribed. Amount may be that the difference is exceeding 5 lakhs. So that is amount, or percentage may be the difference is exceeding 10%. So first, when assessing officer will go as per clause B subclause 1, where your value, which is now not as per the registered valuer, is at variance and the variance is having a difference of some minimum percentage or minimum amount, then he can go to the valuation officer. Second, having regard to the nature of asset and other relevant circumstances, it is necessary to do. Example is any metal like gold, like copper. Why this? Because the nature of the asset is such that it is very volatile. Plus, it has no recorded value. So even though you can file gold prices written in the newspaper, but if you go to the market, still there would be some variance. So where considering the nature of the asset and the other relevant circumstances, if the assessing officer feels it should be done, he will send your case to valuation officer. So basically, what I understood in this, I'm just sharing. So you said if assessee claim value on purchase and not on FMV, then also this section will apply. The answer is he has to by default take some fair market value only because the law has asked in different sections to take fair market value. So whatever value you are taking is assumed to be the fair market value because the law has asked you to take the fair market value. I hope, Beda, I could answer your query and it is clear. So this section will apply in all those cases where the law has asked the value to be taken as fair market value. And in all those cases, whatever value you have taken, which is now assumed that it is fair market value taken by you, the officer can refer the case to valuation officer and get the value confirmed. Fine, beta. Next is from Soumya. She's saying, sir, income arising out of income earned by a minor child. Yeah, super. This is always my favorite question in clubbing. Minor child's clubbing. Correct? Now, what is the question she's saying? The minor child has earned the income out of his or her skill talent. Can this be clubbed with the parent of minor child? Super. I think this is a very straightforward question, Soumya Beda. The section is very clear. Wherever one, the minor child is a disabled person, physically, mentally challenged, or two, the minor child has earned the income from application of his skills. Like we see so many child artists in television serials, in movies. There are singers, there are people who are participating nowadays in so many different activities. And let me tell you, none of this is child labor. Child labor has a different concept. We always feel that anywhere where any child is doing something, it is a child labor. Had that been the case, which is we all know is illegal, then no movie or no serial would have had child artists, right? We have in fact as young as few months old children a part of some movie or especially part of many ads. So that is not what is child labor. That is altogether different concept. So the point is that whenever the earning, the income of the minor child has arisen by way of using his or her skill, like I gave you few examples, that will not be clubbed. But let us say the minor child has participated in some competition. Nowadays, you have so many dance competitions, you have singing competitions. So where he has participated. Now, interestingly, you will say, sir, but there also he or she has used the skill, correct? But ultimately, over there, what the minor child is being paid for is not paid for the skill because everyday singing, dancing, he or she is not paid anything. Finally, whoever will win, and majority times the win is from voting. So that does not, I repeat, that does not comes in the exception, and that winning will be clubbed with the parent. So you have to be very particular that whether actually the income is by applying the skill talent or it is because of some winnings because the child participated in some contest or competition. Fine, beta. Clear with all both the queries. Another query is from Shagufta. She says, sir, I didn't understand additional depreciation, half full depreciation. See, beta, additional is what? One is regular depreciation, like how we claim in accounts. At some percentage, you claim depreciation every year. That is regular depreciation. Over and above that, if you satisfy some conditions, then section 32, subsection 1, clause 2A provides you the deduction on account of additional depreciation. That additional depreciation deduction will be one where you are a manufacturer, maybe individual, maybe company, etc. Makes no difference. You are a manufacturer. Second, the asset is a new plant or machinery. And third, the asset is used only in production and not in office. So when all these conditions are satisfied, besides the regular depreciation, which is generally 15% for plant and machinery, you are allowed to take over and above that 15%. So 15% you are claiming, you are allowed to take further 20%. So that is why it is called as additional. And the condition is it can be taken only once in the first year when the asset is put to use. Second, You asked what is the difference between full and half. So the rule is, when you look at accounts, in accounts, when we compute depreciation, we compute day basis, month basis. So you go as precise as if the asset is purchased on 15th of August, you will compute depreciation from 15th of August to 31st March. However, income tax losses, we will not go so pinpointed by the days or the month. We will simply do what? We will see when the asset is put to use, and then they have given a cutoff, which is of 180 days, which if you calculate backwards, it comes somewhere around 2nd, 3rd of October. Why two dates, 2nd or 3rd? Because there could be a leap year. So that cutoff date is important, which simply means if your asset is put to use after this cutoff date, then by default, it will be put to use for less than 180 days. Then for that asset, you will be allowed to take half depreciation. Half means the rate of depreciation is 20, you can take 10. The rate of depreciation is 25, you can take 12.5. This rule of half depreciation again applies only in the first year when the asset is purchased and also put to use in the same year. In any other case, even though the asset is put to use for less than 180 days, this rule of half depreciation will not apply. Is this fine, Beda? Any further questions with anyone? No? Great. So now we go to our today's topic. The topic is called as deduction under chapter 6A. Firstly, why it is called as deduction under chapter 6A? I'm sure you will understand this. What happened? See, why it is called as deduction under chapter 6A? The reason is, in the income tax law, you will find that the entire law is divided into chapter like any other book, and every chapter has some number of sections. Like first chapter, you can see there are 3 sections. Similarly, if I go to chapter 3, which is dealing with incomes which do not form part of total income, which we call as exemptions, there are so many sections. Then computation, you already studied. Then income of other persons, which is clubbing, you already studied. Then aggregation, which covers carry forward set off, and this chapter. Now this chapter, which is what we are going to study now, is or was, sorry, not there originally in the act. So originally, the act did not have any concept like deduction. Later on, as the act started progressing and new government started bringing different policies, so they felt that we should allow some benefit from the total computed income. This benefit is that that much amount could be deducted from your total computed income. That is what is called as deductions under chapter 6A. Why? Because it is placed in chapter number 6A. I'm sure by now you all would have come to know this, that whenever a new act is drafted, it will never have any section like 43B. It will never have any section like 40 capital A, or it will never have any subsection like 1A. There would be either numbers or there would be either alphabets, not a combination of two. But when the act is already drafted, passed, and then over a period there are some amendments, and that amendment has to be fitted in between two provisions. So already you have provision number 23 and 24. Now you want to add something in between this. The only way is to bring it as 23A. Similarly, for chapter numbers, since this entire part was brought in later on, it was added in this act, hence the entire chapter got to be named as chapter 6A. Fine. Now, what is this deduction concept? So you have computed your income under different heads. Out of 5, let us say you have income under 4 heads. So you don't have salary, but other 4 heads you have. So you have house, property, business, capital, and other sources. And within each head, you have multiple sources. Like under business, you have 2, 3 businesses. Under house property, you have 5. Under other sources, you have multiple dividends also, interest also, gift also, so many things. You added up all the respective head incomes. If there were losses, you net off the losses within the same head first. After netting off, you brought out the final income of each head. If again there are losses in any head and the law permits under section 71, you also did the netting off of losses between different heads, which is called as inter-head adjustment. And then you finally reach the figure of GTI, that is gross total income. Now, this chapter 6A is what? In order to promote one, investments, two, savings, three, certain payments. The government, or let us say not government, more correctly, the parliament decided to give you some incentive. What is that incentive? If you do any of these three things: investment, savings, payments, in those areas where we are telling you to do, and subject to the conditions, limits which we have given, if you do that, we will allow that amount of your investment or your savings done or your payment done to be reduced from your GTI. So practically what will happen, how this is an incentive, because if your GTI is getting reduced, obviously what will happen, your final net taxable income on which you have to apply the tax rate will reduce, so your ultimate tax liability will reduce. So this is what is chapter 6A logic. Government want to promote investments, promote savings, or promote payment in certain scenarios or in certain areas. That is how this section has come to origin. Fine. Now, with this background, let us understand there are two types of deductions. One is what you find in section 80. See this 80 list, multiple ABCD sections, which are all falling in chapter 6A. There is another deduction which is under 10AA. Now I'm sure you all would have till now known section 10 as an exemption section, but within 10, there is another category which is 10A, 10B, 10BA, 10AA. All these 3-4 sections are not exemptions, they are deductions. Now, interestingly, somebody would like to ask, sir, what is the difference between an exemption and a deduction? One thing is common between the two. In both cases, as a taxpayer, as an assessee, you are benefited because both goes to reduce your income. That is common. So income reduce, tax reduce. But there is a conceptual difference between an exemption and a deduction. Exemption is qua the income. If I say agriculture income is exempt, it means I'm talking about that income, and I'll go a step ahead to say I'm talking about a source. So I'm saying that income arising from the agricultural source is exempt under section 10 bracket 1. In this particular case, whoever will earn that income will not be required to pay tax. So in case of exemption, you can just imagine like this, I virtually keep that source out of taxation. I say that this income, entire source out of taxation, don't consider it. Neither the receipts of that source, neither the expenses of that source. Hence, I'm saying entire source out. What are deductions? Deductions are, you have now earned income from various sources. Now I'm asking you, out of that income which you have earned, if you are doing any such thing, which I want you to do, that will be allowed as a subtraction from the total income. Since I'm allowing this amount to be subtracted, it means this source is not originally an exempt source. In fact, many of these examples or cases which you find on your screen will be dealing with payments. So these are various payment sources where you have to pay or where you have to invest. There are few income sources also, majority, but these are payment sources. So wherever you make payment, you make your investment. I say that, okay, that amount of payment or investment, I will give you as deduction. So practically, mathematically, this amount is subtracted from your total income. In case of exemption, that amount is completely kept outside the computation. It is never included in the computation in the first place. That is the major difference between an exemption and a deduction. Also, an exemption is qua income, means it is always related to income. A deduction may be related to so many things. It may be related to payments, investments, savings, even certain sources of income. So deduction can be related to many things. Now, 10AA, even though it is a section 10 category, it is not an income which is an exempt income. Rather, it is an income, or it is a source which is first to be included in your total income. So it is a taxable income. And then you are allowed some part of that taxable income as deduction. That is what is 10AA. Right? Great. So already I have a concern on the screen. So the concern is, sir, I'm scared to see so many deductions. And obviously, the scare is not about the number of deductions. The scare is about, do we need to remember? And most importantly, do we need to remember the section numbers? So this is that fear. So firstly, let me make it very clear. I always believe in remembering, learning the section numbers. Why? Because that is the basis of any legal subject, and taxation is one of the legal subjects. Without knowing the sections and the section numbers, you cannot have that specialization or expertization of that subject. Now, coming to the challenge then, ki, sir, if you're saying ki, yes, you should learn, how to learn? Don't worry. I'll give you some very interesting technique approach which will help you learn, recall majority of these sections. So you will be able to learn and recall what is ATC, what is CCC, CCD, etc. Just to give you a glimpse how you can learn, or how you will be able to remember and recall. See, I'll just give you the most simplest example. You have a section which number is G, correct? So how do I remember this? G for God, and for God there is donation. Now when you see what is ATG dealing with, ATG is giving you deduction when you are making payment. What is the nature of payment? The nature of payment is donation. And to whom have you given this donation? You have given donation to different funds, charitable institutions, which mainly is the ones which we see around. Majority of them are religious, educational, social, cultural. So remembering will not be a challenge. G for God, and for God there is donation. Another example, you again have donations, GGA, GGB, GGC, right? Though either they have not used the word donation, they have used the word contribution. Contribution means donation because you're not getting anything in back return. Now, how do you remember this? Same rule. G for God, and for God there is donation, right? So this is how I remember that this is also for donation. But how do I remember that it is donation for what? So firstly, when you are giving donation to God, God is happy even with your 10 rupee donation, even 100 rupee donation. But when you have to give donation to a political party, it has to be X times. So X is multiple times. So that is why God is satisfied by 1G, but political parties require X times. So they have 2 times G. So 80 G G. And without taking names or without taking sides, B and C are today the two biggest political parties of India. So simple way to remember that 80GGB and 80GGC both deals with donation, but to whom? Donation to political parties. Easy to remember. I'm sure you'll not forget this. GGB, GGC. Similarly, GGA. It is again G for donation, and GA is the incomplete spelling of Gaon. If you have to write gaon in English, how will you write gaon? That will be GAON. So 80 GGA is donation in respect of rural development, poverty eradication, etc., etc. Means it has some connection with gaon. So even GGA, easy to remember. Yes, Priyanshi, now you are getting the feel. So Priyanshi has rightly pointed out. So sir, it means when we go to the series of D, so she says, sir, D for doctor. So the entire series of D should have some connection with medical. Exactly. If you see the entire series of D, you will find some connection with medical. So D is for doctor, but here for me, D is not always for doctor. What it is, I'll tell you. So it is interesting. You don't worry. I'll ensure that 90% of this is easy to remember. Chalo, I'll give you the best one. 80 QQB. This is my favorite. Okay. Firstly, I'll tell you it is giving deduction to whom? It is giving deduction to people like me who are authors of different books, right? And QQB is a question which is asked by poor kids like you all who are always troubled with so much of studies, so much of books. So as a innocent child, you are asking people like me, cruel people like me who are authors, क्यों क्यों बनाए books? QQB. So an innocent child is asking a question, क्यों क्यों बनाए books? 80 QQB. Income of an author from books. Simple. We have so many things. JJA, do gulam, do ikke, because it is dealing with employer-employee deductions. So do gulam, do ikke. You play playing cards, gulam, ikka, employee, employer, right? So we can do so much of creative thing to remember even the difficult most things. See, this is the beauty of studying. You have to just carve out a way so that you can remember things, though there could be certain things which may not always be possible to remember. Even if you are able to do 75%, 80% of the subject like this, that much load is gone, right? Remaining 20-25 will manage. So coming back, so what is it saying? Deductions from gross total income. Now, by now I'm sure you are aware that we have two methods of computing income and tax. One is your new scheme, which is the default regime, and the other is the old scheme, which is now the optional scheme. So if nothing is mentioned, you'll always go by the new scheme even while solving, because new is the default. So if the question says nothing, you have to keep in mind that you have to solve it by the new scheme, which is the default scheme, and give that note. Second is the old scheme. Now, interestingly, as you understood when I explained at the start, that this chapter was not there in the law originally. So originally, law was more simpler. However, what happened with passage of time, different governments, different thought process started coming in. So this chapter was introduced to give benefits in the form of deduction. Now, actually, you will say, sir, so such type of benefits were not there. No, they were there. There was a different section, section 88. Now, nobody knows what is 88, but there was a section 88 which was called as a rebate. So out of this, many of these deductions today were earlier covered in another section called as rebate. Today you have rebate, you have that 87A vagara, but that was under 88. Now that section is as good as nil, blank, because we have made a separate chapter here. But what happened? Originally, all these deductions, concessions, exemptions, rebates were less. As the law progressed, for varied reasons, they started adding different provisions. But this made the law very cumbersome, also very complicated, lengthy, and hence now the need came that we need to simplify the law. In fact, the new Income Tax Act, which is proposed to be implemented in the coming year, that has been designed with one of the purpose of making it simple. Interestingly, how to make it simple? When the government took recommendation, the expert committee, which gave the recommendation, pointed out that one of the most important requirements of the law to simplify it and also to achieve different other requirements is to remove all the deductions and exemptions. This is one of the very strong recommendations to the government. Now, problem is today government, or I'll say parliament, has the power to do that because parliament itself has given the deduction and exemptions. But taking it back completely can be a disaster for that particular government. It may not get re-elected, and there could be a lot of hue and cry on the roads. So smartly, 4 years back, the government said, okay, let your regular provisions be as it is. Regular provisions means allowing all deduction, all exemptions, everything. What we, as you can see here, they have written normal provisions. So regular provisions or normal provisions be like this. But let me give you an optional scheme, which is the new scheme. Today it is compulsory. Earlier when it was introduced, it was optional. And in that new scheme, we will say that we are lowering your tax rate. So regular tax rate is 20%. Here tax rate may be 10 or 12%. Regular tax rate is 30% for a particular slab. Here 30% will be reaching after a big, huge amount of income or slab. So what we did was we introduced a parallel mechanism of computing tax where we removed all the deductions, exemptions, excepting very few. Only very few deductions and exemptions were retained, remaining all were removed. So you can just visualize today also when you are computing, you'll find that computing under the new scheme is much simpler because you don't have to do many of the workings because all are removed. No deduction, no exemption for majority of things. You would have realized this in the chapter of salary, even in few provisions of PGBP. Now here this entire chapter, you can say virtually the entire chapter is not applicable when you're in the new scheme. Though there are one or two sections which are applicable, but virtually entire chapter is out of the new scheme. So the thought process is they want to simplify the law. And for simplifying, the recommendations out of multiple pointers, this was one of the strongest pointers that remove these deductions exemptions. This is why today, when we are reading this deduction chapter, keep at the back of the mind, this is applicable only where you are computing using the old scheme, which is today the optional scheme. Correct? In new scheme, 99% of these are not applicable. Hardly one or two of these are applicable. That once we study, you'll get to know. So broadly, our module is classifying all the deductions into these categories. Deduction in respect of certain payments. Then it is saying deduction in respect of certain incomes. Again, it is saying deduction in respect of incomes and other deductions. I classify it in a different manner. My classification is deduction for certain payments, deduction for certain incomes, and deduction for certain persons. Why persons? That you'll get to know, because if you are a physically challenged person, there is a specific deduction for you. So that is where I'm classifying it in three categories: deduction for payments, deduction for incomes, deduction for persons. Correct? Now, when we see the act, I'll just show you the act because you'll get this reference. This chapter 6A, as you can see, is having so many sections, but these sections in the act are divided into three categories: category A, B, C. So they call it as heading A, heading B, heading C. Now this heading C covers sections starting from somewhere here, H. So up to GGC is the other category, which is for payment. This from H to entire this I, somewhere up to here, H to I, these sections are under heading C. Now, why I'm specifying this? Because one, this heading C is not part of our syllabus. In fact, this whole list is not part of our syllabus, but this entire heading C, which covers section 80H, all this H series and I series, they are heading C. So within chapter 6 deduction, there are different subcategories which are called as heading A, heading B, heading C. So these are all heading C categories. These are out of our syllabus. One very important thing, even though they are out of our syllabus, why I'm specifying this? I could have easily avoided talking about it, but you'll find the reference of this heading C at many places. So you have to understand this heading C, what it is. Heading C covers deductions on account of incomes, where the government is saying, okay, you set up industry in a backward area, the income or profit from that industry we will give you as deduction. Or you start a particular type of business, whatever list they have specified, and whatever profit you will get from that one business, we will give that profit as deduction. So this entire heading C, remember this, heading C, which covers 80H to 80I all sections, is only dealing with incomes earned from some specific sources. Now, this will be referred at multiple places when we are reading the other sections which are part of our syllabus. So I thought of giving you a overall gist as to what this heading C covers. So it covers 80H to I all items, all these around 25 sections, and they are not part of your syllabus. But most important, what these 25 sections cover, they cover deduction for a particular type of income. So you do a particular type of activity. From that activity, whatever income you are earning, I give you deduction. Is this fine? Just keep that at the back of your mind. Now, as I said, 99% of these deductions, what you can see, are out of the new scheme. However, presently, there are only limited, now you can see on the screen, 3 sections which are mentioned. These 3 sections only are eligible under the new scheme. Now here you have one section 80ccd, another section you'll have 80cch. So both these sections, and one section here 80jjaa, do gulam do ikke. Only these 3 sections are eligible for deduction under the new scheme. In fact, out of these 3, the first 2 sections 80ccd and 80cch, these 2 sections are also not completely in the new scheme. Only one part of these 2 sections, as you can see, subsection 2 only is mentioned. There are different subparts of both these sections, 80ccd also and 80cch also. Out of all these subparts, only one subpart which is covered in subsection 2 is only in the new scheme. So even these 2 sections are not completely in the new scheme. Some part of these sections are in the new scheme. So practically 99% of these deductions are outside the new scheme, which is your default scheme. I hope this is clear to all. Any questions or doubts, students? Before we start, anybody has any particular question? Okay, good. Anybody wants to express some problem, some concern? You may put it at the start, like how you did for PGBP. This is what I wanted to hear. So Anubhav is very rightly pointing out a concern. So does it mean that the government is not willing to promote savings and investment? Because as we discussed till now, majority, or not majority, but at least half of these deductions are for making some savings or investments. So by making or removing the benefit, obviously what will happen? People will now not be inclined to investing, which earlier they were, because there were 2 benefits. One, you are investing, so you are saving money for future, plus that investment is also giving you income tax benefit. So it is a double benefit. So people were preferring this, but because of removal of income tax benefit, these deductions are removed. So now people may not be preferring this. So Anubhav has rightly pointed out this, that So does it shows that the government does not want to promote investment savings? See, interestingly, there was a detailed research done. So all these recommendations which I am saying, these recommendations are done after a lot of study, research, data collection, etc. So the government was informed that the millennials, I'm sure now everybody knows what is millennials, the millennials generation is not inclined towards investing. Like they got this information that this millennial generation is not keen on buying a house. Like otherwise, our generation was keen on once we are employed, once we start earning, we have a structured approach that okay, first I'll try to start investing in gold something. As my income earning increases further, I'll go for some car. And as it increases further, I'll ensure that I have my own house, or if I'm already having a house, I'll go for a bigger house. So this was a general psychology up to our generation. However, the millennials, which is today a major earning group, the youngest earning group today, government got this recommendation through their research and studies that this group is not keen on investing. Rather, they are more inclined towards consuming and moving ahead. Secondly, an important point, if we are saying we want to make India 5 trillion, when this 5 trillion will happen? This will not happen if people invest or save. Because the moment you save, it goes out of the economy, not exactly out of the economy, but it is not in the day-to-day circle. When you spend instead of investing, I am spending, it becomes your income. You also have the same approach of spending, it becomes third person's income. Again, that person spends, it becomes again my income. So the money's rotation is faster. So the GDP and all these things, the parameters that we see, why it has increased in the current few years, why we are seeing this superfluous growth of India in terms of GDP and all those parameters, because of one of these reasons. So indirectly, bringing this new scheme and also now making it a default scheme and making the old scheme optional is indirectly making you all spend more, which is rightly pointed out by you, but it is actually benefit to the economy at large. And now, see, you cannot say that people have stopped investing. Now we have got a new way of investing. Now we are inclined more towards shares, which is an investment also, but at the same time, it is volatile also. We are more inclined towards mutual funds. We are more inclined towards those virtual digital assets, which is an investment also. You can hold it till the time you want. There is no compulsion that it has to be done immediately, except for your the short-term investments like intraday and all those things. But for shares, you can always keep it, and it is also liquid at the same time that if you want, you can immediately sell off and get out. So there is investment, but now the medium has changed. And see, whoever wants to buy a house, whoever wants to buy a car, they are doing that. So government is now not going to promote that. Fine. So again, our module is first discussing the same part, what I explained to you, the difference between exemptions and deductions. So they have given few examples, what you have already studied, that these are exemptions. And then it has been compared with deductions, which is majorly in chapter 6A, and then section 10AA, 10B, etc. Those sections. Now, the difference is, as I said, 10AA or entire section, not 10AA, sorry, entire section 10, which is the exemption section, covers only incomes, and that entire source is outside the entire computation. Whereas when you say deductions, it covers few sources of income, which is now our heading C. I hope now you understand what is heading C. So it covers heading C, which is sources of different incomes, 10AA source of income. But besides that, deductions cover so many other things, which are payments, investments. So deduction is that after you have earned the income, which is part of taxable income, now how you are spending the income, that gives you deduction. So that is what is the basic difference between exemptions and deductions, which has been carved out. Now we come to the first section, section 80A. So what does section 80A does? Section 80A is not giving you any deduction. 80A, 80B, these are not giving you deductions. They are not telling you where you will get deduction or by doing what you will get deduction. It is not doing that. So these are not deduction sections, but these are giving you some rules, some conditions which you have to follow when you have to claim the deduction. So deduction starts from 80C. But before that, this 80A, 80B, 80BA, all these sections before C are giving you some conditions, some parameters. Now, before we read these, let me inform you, when you are studying the topic of deduction, you have to keep in focus few things. First, who is eligible for deduction? When I say who, this who means the assessee, individual or a company or a partnership firm or all of these or two or three of these. So who is eligible for deduction? This is the first thing you should check out for. Second thing that you have to check out for is for what payment, that is what for what uh, expenditure or payment you are eligible. So this is the nature of payment investment that you have to do. So who are you? Second, what you have to do. Third, up to what amount you have to do, because there is some monetary limit. You cannot put your entire amount in any of these sections and get deduction. That is not allowed. There are some upper limits. So who will get, for what they will get, and up to what amount they will get. So these are the three things you have to look out for in every deduction section, and plus some more conditions which may be procedural conditions, which may be substantive conditions, but major are three: who, for what, up to what. These are the three things you have to look out for. Now, Dhanush, which will be more beneficial to the assessee, that depends upon a comparative working. See, we as professionals develop this habit, beta. You should, whenever you have options, you should always do a comparative working. And you should never try to jump to conclusions orally, because I can give you 100 such assessees data where even though the GTI is same, but for some old scheme is beneficial, for some new scheme is beneficial. Why? Because what is the composition of their GTI? What are their other savings and investments which they are by default doing? So comparing all that only, you will be able to decide. So there is no such rule what is beneficial, new scheme, old scheme. But yes, a generic rule can be that whoever is majorly spending their money and not investing, for them generally, we say that new scheme is generally beneficial. Fine. Now going to these conditions, what does these conditions say? That the deductions are given only in 80C to 80U. So these are the only sections for deduction. And these deductions are mainly given when you opt out of the new scheme. That is, in short, it is only for the old scheme. Second, these deductions are to be subtracted from the gross total income. So these deductions can never exceed gross total income. So let us say your gross total income is 20 lakhs and all sections combined 80C to 80U is 22 lakhs. For example, still your deduction will be limited to 20 lakhs. You cannot say that since I have invested or made payment more of 22 lakhs, that is 2 lakhs more, that 2 lakhs of my excess deduction should be carried forward and given to me in the next year. That will not happen, because your deduction is limited only up to gross total income. In fact, as we proceed, I'll inform you it is not even up to the total gross total income, because your gross total income has income from 5 heads. All these 5 heads income is not eligible for deduction. So first point, your deduction cannot exceed the gross total income. Next, if we are talking about AOP BOI, which now we know is a group of individuals or a group of persons, once a deduction is claimed by any one of them, that is, if AOP BOI is claiming a deduction, the same thing cannot be allowed again to the member. So once AOP claims deduction, no deduction for the same thing will be allowed to the member of the AOP. So this is very obvious. So only one of them can claim the deduction, either the group can claim or either the individual member can claim. Then comes the interesting part. You will find that between these three categories, section 10AA, which is one of the deduction sections, chapter 6A, heading C, and this is where I first explain you heading C. Why? Because heading C will be referred at many places. So what is this chapter 6A heading C? Heading C is deduction in respect of certain incomes. It covers incomes between 80H to 80I, and all are different businesses which the government wants you to engage into either a particular nature of business or in a particular backward area, backward state, or some hilly area, etc. And if you do that, the income from that business is given as deduction. This is what is heading C. Now the same thing may be covered in 10AA also. What this point is saying, that let us say your business nature is such that it is covered in 10AA. Now let me just tell you what is 10AA also, so that that also will be clear at the back of your mind. If you have started your unit in a SEZ, special economic zone, that unit is what is 10AA eligible unit. So what is 10AA deduction? 10AA deduction is a deduction for those units who are in the SEZ, first condition, and second, 10AA gives deduction only for their export income. So if you are in 10AA, that is SEZ, but at the same time, the nature of business is such which is falling in heading C. So there is a possibility, because heading C covers so many sections and it covers so many types of businesses. So there could be a possibility that there is overlap. If there is overlap, the law is clear. You can claim deduction under any one of them, not both. So if you have claimed deduction under one, deduction shall not be allowed under the other. This is the simple point. Next, when you are claiming deduction here, that is in the above point, which is either 10AA, which is again a business income because you are a SEZ unit, or heading C, which is again covering so many sections, all dealing with business only. So entire 10AA and heading C, both these sections cover different types of business related incomes only. What they are saying in this fifth point, that your deduction from these sources cannot exceed the profit that you have earned from these sources. So that is obvious. So whatever PGBP income you have earned from these sources, either the SEZ unit or these businesses which are covered in heading C, that income which you have included in your GTI, maximum that amount only you can reduce as deduction under chapter 6A. So where you are eligible for deduction under 10AA or heading C, that deduction should not exceed the amount of PGBP income which is covered in your GTI. This is what is the point. Is this clear? Asta, but I just clarified deductions cannot be carried forward. So that is in fact what was the point above, that deductions will be limited to gross total income. So if your deductions are more than gross total income, you will not be allowed those deductions. So there is no question of carry forward. So this is what is point C. Asta, I hope you are clear with the point. So there is no question of carry forward because carry forward is not allowed in case of chapter 6A. Hmm. Now, another requirement for the same category, that is 10AA and heading C, is that you will not be allowed the deduction under this category, the 10AA or heading C, if you have not shown that exemption, sorry, shown that deduction in your income tax return. It means this condition is, if you fail, if you forget to claim that deduction by showing it in your returns, it means when you're doing your computation, when you're preparing your returns, you have shown all the 5 heads, but below that, that is below GTI, you forgot to fill in the details of deduction. Deduction is not automatic. This is what this point means. If you forget, if you fail to show the deductions in your returns, the deductions are gone. You will not be allowed the deduction. Now comes a very interesting point, which is in point number 7 or subsection 6. It says that there is a possibility you have two businesses. One, which is eligible under this section 10AA or heading C, which covers different businesses only. Two, the other business is not in the list of heading C. So let us, I'll give you example. Heading C, which covers so many businesses. One of the businesses infrastructure development. So let us say you are constructing highways, you are constructing metros, etc., which is infrastructure, which is one of the eligible business under heading C. Another business is a cement factory. So you are also engaged in manufacturing cement, which is again a business, but it is not covered in the list of heading C. So possibilities, you are having two different businesses. One eligible under heading C, that business income is eligible. Two, another business which is not eligible under heading C. Now there is a very good possibility that both these business are serving each other. Like cement business, whatever cement is being manufactured by the cement business is what is sold to your infrastructure business, and it becomes one of the inputs in the infrastructure business. So your infrastructure business is using the cement produced here for doing the construction. Very possible, and it is allowed also. Law has no problem. Now understand this. Your cement business is fully taxable, whereas your infrastructure business has some deduction for the profits. Now, there is a possibility you'll arrange your transaction between two businesses in such a fashion that your cement business, which is supplying cement to your infrastructure business, is selling the cement to the infrastructure business at a very low price. So one bag is for rupees 500, it is selling it for 100 only. What is the impact? The impact is, since you are showing your sales at a low price, your cement business is showing a net PGBP loss because your sales are at a low price. At the same time, what is happening? Your infrastructure business, which is one of the business covered in heading C, since it is getting its major component of raw material, which is cement in our example, at a very low price, the net profit of that business is very high. So, see, effectively, there is no net benefit to me because both are my business. It is simply removing the money from this pocket and putting in this pocket. If you remove less and put more, one pocket is heavier, the other is light, but both are my pockets only. So, effectively, there is no net benefit to me. But a very big difference is by doing this, I am able to reduce my overall tax liability. How? Whatever income I'm showing in my infrastructure business, which is even though appearing as very high, I'm eligible for deduction here. So I will claim the deduction and I will not pay tax on that very high income. And at the same time, whatever is my loss in this cement business, this loss I will use to set off against other business incomes if I have. So I may be having multiple other businesses also. I will set off this loss against those business incomes, thereby reducing the overall tax liability of other business income also. So even though within my pockets there is no much difference because both are my businesses, but by doing this, I overall reduce my total tax liability because I'm booking higher income in the eligible business, and that is by showing a loss in a not eligible business. Where I am doing any such type of within business transactions, they say that the transfer price, that is the price at which I'm transferring something from this business to that business, shall be determined on the basis of market value. So they are saying then whatever price you are showing, we will not accept that because there is a possibility you would have done this type of adjustment. Hence, the law says while computing the income, I will consider the FMV of these items so that both businesses should show a fair profit or fair income. And then they have defined what is market value. So that is nothing but fair market value. Again, what they are saying is, again, they are talking about this deduction under heading C, which covers different types of businesses. And also, I'm sure you remember in PGBP, we have this section 35AD, which again covers specified businesses. Now, when I have 35AD, which is also giving me a list of some specified businesses, heading C is also covering list of specified businesses, the possibilities, again, both these lists may have overlap. Means few businesses may be common in the two. Same point what we studied above in point number 4 is same point is point number 9 here. If I have some businesses which are overlapping in both the lists, I can claim benefit only under one of the sections. So if I claim benefit of that business under 35AD, as per 35AD provisions, I cannot claim benefit under heading C. And if I want to claim heading under benefit under heading C, I should leave the benefit of 35AD. So both benefits at the same time will not be allowed. So in short, 10AA, heading C, 35AD. These three different sections gives you deductions or benefits from PGBP income only. If there is overlap, the law is very clear. You can take only one of the benefits, not multiple benefits. Then there is a section 10AB which says that deductions which are covered in chapter 6A, again heading C, shall be allowed only to the extent such income is computed in accordance with the provisions of this act. So again, heading C, they are all different types of businesses. So when you want to claim the deduction for heading C items, the business income should be computed as per PGBP provisions. Nothing great. Now, what is important is 80AC. Again, it is dealing with deductions under chapter 6A, heading C. What it says, now first, remember there was a condition above that for claiming deductions, you need to show that deduction in your returns. So first condition was, if you fail to show it in your returns, I will not give you deduction. It means deduction is not automatic. You'll have to show. And now it is even more important because you have two schemes. How I will know which scheme you are going for? Though at the time of filing returns, you have to take the option. But the point is that they are very clear. You will have to claim, you will have to show the deduction in your return. Then only we will allow you the deduction. Now, a second condition which was added later on, and that is why the section number is 80AC, is that this return should be filed within the time limit of filing the return. And I'm sure by now you also know that the time limit of filing return is specified under section 139 bracket 1. So first thing, you have to show the deduction in your returns, condition 1. Second, the return is filed within the due date of filing return under section 139. If any one of the condition is missed, you will not get deduction specifically on heading C, because this condition that the return should have been filed in time is applicable only for heading C deductions. So if you file return late, your heading C deductions are gone. Simple, correct? And what are these heading C deductions? They have given you the list. It covers H and I entire series. Now they have not given you the H list. Why? Because today all the sections under H are more or less defunct. They are out of the scope. Hence they have not given you the list. So these are the various sections covered in 80, under chapter 6A, heading C. Major is H and I list. Then there are few other small sections also. So final point is what? The effect of this provision is that in case of failure to furnish a return of income before the due date, the undertaking will lose the benefit of the heading C deductions. So heading C deduction, return should be filed within due date. Otherwise you miss those deductions. Now, now coming to another section, that is 80B. Till now we were dealing with the conditions of 80A. Now we go to the conditions under 80B. What does 80B says? It is trying to define what is gross total income. So it means gross total income means the income computed as per the provisions of our act, and it is the income before claiming the deduction. Obviously, GTI will come first. After that only you will claim deduction. So the GTI is the income as per all the provisions, all heads, set off everything, but before claiming the deduction under chapter 6A. So what it says? It says that while computing this gross total income, deductions under appropriate computation section should have been given effect. Like you have seen that salary has some deduction, standard deduction, HP has deduction P. So those deductions you should allow, because those are not chapter 6A deduction, those are respective head deductions. So while computing GTI, while computing each source of income, you have to claim the deduction under the respective head. Second, you should do clubbing wherever applicable. Third, you should do all type of set off. Wherever you have brought forward losses, that can also be set off, do the set off. After doing all this, what is the total is your GTI. And then from this GTI, you will be allowed deductions under chapter 6A and 10AA as per the different categories. Yes, Asta. So you're right. So I'll just correct what you said. So what Asta is saying, I'm giving you the corrected version, that for claiming any deduction, entire chapter 6 deduction, the condition is that the deduction should be claimed, means shown by you in the return. So showing the deductions in the return is the first condition, which is applicable for all deductions. Second, the return should be filed within due date. This is the condition only with heading C. So only heading C has the condition that the return should be filed within time limit. But for all deductions, the condition is that you should show, you should claim the deduction in the return. So if you have not shown the deduction in your computation, the deduction is gone. One, it is applicable to all deductions. And you have shown it in your returns, you have claimed it in your returns, and the return is filed late, you will get other deductions, but you will not get heading C deduction. So Asta, you're right. I've just corrected your sentence. Fine. So this is the entire backdrop of the deduction. Now, one thing which is not covered, I would like to add further before we start with specific deductions is I had mentioned before that deductions are not allowed from all the incomes under all the five heads. So even though we are talking about GTI and we are talking about five heads, some incomes are not eligible for deduction, which means what? If you have certain incomes, the deductions cannot be subtracted from those incomes. So now see, we have five heads: salary income, HP income, PGBP income. No problem. For these three incomes, if you are having, you can subtract the deductions to the extent they are eligible. No problem. The problem is only with the other two. One is your capital gains, and the other is in other sources, you have one income called as winnings. So in capital gains, the restriction is where you are showing your capital gain under section 112, 112A or 111A, these three special sections of capital gain. For these capital gains, deductions are not eligible, means you cannot subtract the deductions from these three capital gains. 112, 112A is for long term, 111A is for short term. So from these special sections, because these are three special sections, why? Because they have special tax rates. And the next is winnings, again, which has a special tax rate of 30%. So roughly, how I remember this, that deductions are not allowed where the law has given you a special tax rate for your income. And majorly, these are the three special tax rate incomes. Four, sorry. So for these special tax rate incomes, two long term, one short term, and one winnings, deductions cannot be subtracted. So even though you have those deductions, you cannot subtract it from these three or these four types of special incomes. Is this clear to all? Yes, 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 Beda. P, I think you're Smriti, right? Miss P or Smriti, na? If I'm recollecting, if my Smriti is correct, because Smriti also means remembrance. So Smriti, you are right. Even for 10AA, the return should have been filed on or before the due date. Correct. Okay, students will take our break. And after the break, we start with these respective section deductions. Sir, how much time is our break? Manish ji? What is our total time allowed? 10 minutes? Perfect. So students, we reconnect in 10 minutes and then we'll take forward the respective section deductions. Continue, students. So now, after understanding the background of all these provisions and how the entire chapter is designed and how it is fitting in the entire income tax law, let us now go to respective deductions. Now, the best part is all are independent. C will have no connection with the other ones. However, in one or two cases, you will find that they have drawn some comparison, they have done some clubbing. Clubbing means they have given a common limit, but otherwise, these are all independent provisions. Now, we first start with 80C, the first section of deduction, and this is the most longest section of deduction. Longest means it has covered around 26 items, 26 investment areas, 26 payment areas for which this section gives you deduction. Now, what are those investment areas and what are the limitations in respect of the maximum amount to which this section gives you deduction? Let us understand. So first important point to be noted is that this section is giving deduction only to individual HF. Again, it is giving deduction only under the old scheme. So that anyways, now we are clear. There are only three sections which are eligible for both old and new. Remaining all are only eligible for old. What is important to be noted is that majorly 80C, that is this section, is giving deduction to individuals and HF. However, in one or two cases, you will find that it is giving deduction only to individuals. Why? Because those payments are possible only by individuals, not by HF. So that is also logical. Like in case of employee, when we talk about employees contribution to provident fund, which you have now studied in salary also, you have seen the some impact of this in PGBP also. So by default, only an individual can be an employee and only an individual can do contribution to the provident fund. So by default, that deduction will be allowed only to individual. Their HUF is not there. Otherwise, the general rule is individuals and HUFs are eligible for deduction under 80C. What is the total limit? All these 25 items combined. You may make payment in different of these items, but the total amount which you can claim under entire 80C of all these 25 items combined should not exceed 1,50,000. Now, what are the different payments given? I'm just reading out the headers and we'll go to the details of the those pointers where there are some technical things. We'll go to that. First is you have invested in a unit linked insurance plan. It is also called as ULIP. Now there are different plans, as you can see, 1971 plan. Then they have given unit linked insurance plan of LIC mutual fund. Below also you'll find some ULIP. So first is ULIP. In short, this is called as ULIP, that is unit linked insurance plan. So if you are investing your money in this particular scheme or plan, you are eligible. Now, the most important is this premium paid in respect of life insurance policy. Now, we all understand what is life insurance. Now, see, there are different insurance. Major is life and the other one is health or medical. Health or medical is covered in 80D. It is not covered here. This 80C covers only life insurance premium. However, within life insurance, there is one important technical aspect which you need to remember. What is this technical aspect? That is what this table is dealing with. So let us take an example. I, as an individual, am investing in life insurance premium. Now, some terms you need to understand. The terms are what is the policy amount or what is the sum assured. So in our layman's language, we say कि भाई मैंने 10 लाख का पॉलिसी निकाला. So policy amount is 10 lakhs. So 10 lakhs is policy amount, or it is also called as the sum assured. So remember this, what is sum assured? It is the amount of policy. Now, remember this date. The date is 31st of March 2012 or 1st April 2012, whatever. If your policy was taken up to 31st March 2012, if you had taken the policy, which is continuing even today because life insurance policies can run for 20-25 years. So if you had taken the policy up to 31st March 2012, then you are eligible for deduction of the premium which can be up to 20% of your policy amount. So see, every year we pay premium. That premium is what is your investment. That is what is eligible under 80C. Now, taking an example of this, let us say my policy amount is rupees 5 lakhs. So I have taken out a policy where the policy amount is 5 lakhs. So that is what is also called as capital sum assured. So sum assured, capital sum assured is that 5 lakhs. Fine. Now, if I have taken out a policy of 5 lakhs, which is my policy amount, then I have to see when have I taken out this policy. If I have taken out the policy up to 31st March 12, so let us say my policy was taken in January 2010, for example. So it is before this date. Now, if I am paying premium of 80,000, it is eligible for deduction, entire 80,000. Why? Because the maximum limit for such policies taken out up to 31st March 12 is 20%. So I can pay maximum premium up to 20%. I can pay more, but the law will give me deduction up to 20%. So 20% of 5 lakhs is how much? It is 1 lakh. My premium is 80,000. It is falling within the limit. So I can take entire 80,000. But if my policy is taken after this date of 2012, then the limit is only 10%. So same example, I have taken out the policy on 1st January 2013. So the policy is taken after this date of 1st April 12. Now for the same 5 lakh policy, if I am paying 80,000 as premium, I will not get deduction of entire 80,000 because now my limit has become 10%. This 10% comes to 50,000. So even though I'm making payment of 80,000, that is that much amount I'm investing in the form of premium in my policy, I will be eligible to get deduction only of 50,000 because of this 10% limit. So this is what is an important point in life insurance premium, 20%, 10%. Now you'll find one more limit over here, which is of 15%, but I will say you can ignore this limit. Yes. Why? Because this limit is applicable only in one case. What is that one case? That one case is where the life insurance is taken on the life of a person who is suffering with a disability. And what is that disability? That is what you study in section 80U, or who is suffering from a disease which you will study in section 80 DDP. So there are two sections which we are going to study later, maybe in the next class. So if the person for whom you have taken this life insurance policy, that person is either disabled person or suffering from severe disability, then you are allowed a deduction of 15% instead of 10%. Now this deduction was introduced from 1st April 13. So from 1st April 13 onwards, instead of 10%, you are allowed a deduction of 15%. But you can ignore this because this is unnecessarily complicating the thing. Just remember this cutoff date, 31st March 12, because in majority of the sums, the life insurance premium which you are paying will be for a person who is not a disabled person or suffering from disease. So you have to remember this 31/12 due date, 31st March 12 due date. If policy is taken out before this, you can claim deduction up to 20%. The premium can be up to 20% of policy amount. If the policy is after this, the premium can be up to 10%. Now, if you go by logically, your sum should give you policy after this date only, logically. And even if they have given you a policy before this date, it will be well within all your limits. So this is what the law provides. Remember this cutoff date, 31st March 2012. Next payment is, you have paid premium. Now the premium is paid for another type of policy, which is called as a deferred annuity policy. See, there are different plans of insurance companies. This is another plan. So you have the ULIP plans, you have life insurance, you have the deferred annuity. Next, again, this is the deferred annuity plan, but now it is for whom? This is for government employees. So effectively, all first 5 points are relating to insurance only. ULIP or life insurance or deferred annuity. Now, This point is giving deduction only to individuals. Why? Because it is dealing with contribution to provident fund. In fact, this previous one, fifth one was also for individuals because it was talking about deduction from the salary payable of a government employee. An employee can only be individual. So as we are seeing, entire ATC is for individual and HF both, but there are few sections which are only for individuals, and they are the one where employee related some payments are given. Now, employee contributes in provident fund. Now you have studied there are three types of, or rather four types of provident fund. Statutory provident fund, which is applicable to government employee. For private employees, there are two types of provident fund: recognized, unrecognized, and there is something other than this called as PPF, that is public provident fund. Out of these four, if you are contributing to unrecognized provident fund, that is not eligible for deduction. So effectively, only three provident funds are eligible for deduction. One is statutory provident fund, that is for government employees. Then PPF, which can be done by anyone, whether employee or even self-employed. So you and me, even though not employees, can also do this. And then for private employees, the recognized provident fund. So any of these funds eligible for deduction. So when you contribute your money to any of these funds, which is generally done by the employer itself as a deduction from your salary, so you are eligible to get deduction under this section, that is 80C. Again, this you have studied in salary chapter, where you are contributing to another fund called a superannuation fund. So for superannuation fund, again, which will be applicable to individuals because this is an employee driven investment, the deduction will be allowed of the contribution made to this fund under this section. Now coming to something important which will be many times covered, is that if you have a female or a girl child, or you are the legal guardian of a girl child. So either she is your own child or you are appointed by the court as the legal guardian. In either case, if you are making payment by opening a special account for that girl child called as Sukanya Samruddhi scheme, then whatever amount you are depositing in this Sukanya Samruddhi scheme will be eligible for this deduction. Right? There is some query. Dhanush is asking, sir, we have deductions at the time of payment, okay. But what about at the time of withdrawal? Dhanush, I'll come to that. Dhanush, this is a very relevant question. You are giving me deduction when we are making payment to these things. These are majorly investment schemes, like now you have seen life insurance, deferred annuity plan, or Sukanya Samruddhi. What will happen when we withdraw? So Dhanush, you'll get an answer. I did not purposefully address your question when you posted, because now the time has come to answer your question, that we'll get to know what happens at the time of withdrawal. Asta is asking, sir, in 5 point, if deduction from salary is more than 1/5, then excess will not get deduction. Yes. So see, beta, 1/5 is 20%. So indirectly, they have given the limit of 20% again. So if the deduction is more than 1/5, you will not be eligible for deduction. So that is, those are the limits. But I did not stress on that limit because that is not very relevant for the exam. Now, Dhanush, answering your question. So for Samruddhi, Sukanya Samruddhi, what they have said, exemption when you get the money from the Sukanya scheme. So now you are withdrawing from the Sukanya Samruddhi scheme. So when you deposited, I gave you deduction. Now understand this. This is like a saving scheme. So when you are getting the amount back, you will also be getting interest. So principal is there, what you deposited, and interest is there. Now principal, what you get is your own money, no income, no tax. But the interest that you are going to earn is obviously income and it should be taxed. However, since the government wants to promote this scheme, under section 10, which is the exemption section, clause 11A was introduced, and this clause said that whatever amount you will get from the scheme at the time of withdrawing from the scheme shall not be taxable because it will not be included in your total income. So accordingly, the interest that you will be getting will be exempt. Similarly, another very attractive scheme and commonly asked in your paper is the National Savings Certificate. Presently, it is the 8th issue that is going. Dhanush, beta, be patient. I said your question will be addressed. That is why I purposefully did not take your question, though you already asked us 10 minutes back. We will go step by step. For everything, I'll give you answer. So just be patient. So next investment is National Savings Certificate. Now, what is this National Savings Certificate? It is like a FD with government. So I want to keep 10,000 in this National Savings Certificate. So I will deposit money. I will get my money after a specified period, which is mentioned in this. It may be 8 years, 9 years. And at that time, I'll get my money with the interest. So this is what is National Savings Certificate. Now, let us say today I deposited 10,000 and the scheme will give me my money after 8 years. Generally, they give me double. So that double is because of accrual of interest. So today in base year or today is year zero. Why year zero? Because from today 8 years would be counted. So today is year zero. I am depositing 10,000. So 10,000 is my this year's investment. I am eligible for deduction of this 10,000. Now, what is interesting about this National Savings Certificate, which is also called as NSC as a short form, is that this is the only scheme where you continue to get the deduction up to the next 8 years till maturity. Now, the question is what for? Let us say I only invest in the base year this year, not again. But in this year, I invested the principal, which is my 10,000. Now, after the end of 8.5 or whatever is the period, I will get double the amount. How do I get double? The reason or the answer I'm sure you all would understand is because every year interest is getting accrued, it is getting added to my investment. Now the law says that when you are earning interest in year one, that is next year, that interest is your income under the head other sources, correct? Yes. So first you will add that income in your income from other sources. But at the same time, you will again consider in ATC of that year. So you are earning income in year one, show it in other sources and also show it in ATC. Year two, whatever income you have earned in year two, show it in other sources, show it in ATC. Year three, whatever you earn income in year three, show it in other sources, show it in ATC. Now you'll say, sir, why? Reason is the government says that when you have earned income in year one, year two, year three, we have not given you back that interest because we are going to accumulate it and give it at the end of this entire certificate period. So effectively, it is like this, you have earned that and you have reinvested with us. Hence, National Savings Certificate is the only scheme where they keep giving you deduction every year. So first year, principal amount, all future years, you just do two entries. One, you show it as income in other sources and immediately you also claim deduction in ATC. Fine. Then the other schemes or plans are annuity plan of LIC, then some notified mutual fund schemes of LIC or UTI, which are notified by the government. Then notified pension fund, which is again set up by mutual fund or UTI. Then you have deposited your money in National Housing Bank tax saving scheme. Then you have taken subscription of some specified deposit schemes. They have given the names. See, I'm not explaining much, and you also need not go into much depth, not very relevant for exam. But since you are studying this subject for the first time, you have to go through the list. They have just explained you the details of the scheme, nothing much. Now comes something important. What is this something important? You have paid the fees for your children. Now, what is this fees dealing with? Now you can see on your screen tuition fees. And whenever we say tuition, what comes to our mind is coaching classes. Because we call coaching classes as tuitions. However, let me make it clear, you don't get any deduction for your coaching class fees here. Then for what are you getting this deduction? Now let us say your child is either in some PG, that is university, or in the college 11, 12 standard, or doing graduation, or still in school, or in any other education institution. And most important, your child is pursuing a full-time education. Then whatever fees you are paying to the school, to the college, see the fee receipt. When you see the fee receipt, there are multiple line items in the fee receipt. So let us say the total fees for the year for your child is 1 lakh. But if you see the line items, it will give you the breakup of this 1 lakh, where it will say tuition fees. Generally, this is the first line item only, 60,000. Then you have some ground fee, then you have some library fee, then you have some particular parent teacher fund, then you have some other books and all, and this total is adding up to 1 lakh. Here, you are eligible for only the first line item, which is named as tuition fee. So here, tuition fee is the fee that you have paid to the school, college, university for a full-time course, and not any other outside coaching class. What is also very important is that this educational institution should be within India. If it is any education institution outside India, because many times people are pursuing such coaching, whatever fees you have paid outside India or to an education institution outside India, that is not eligible. And the limitation is of up to maximum 2 children. This you have found in multiple other sections also. Then comes the next payment where you have taken a housing loan. So for buying your house, you have taken a housing loan, let us say of rupees 2 crores. Now every month the bank is collecting installment from you, which is made up of two components. One is principal, one is interest. Let us understand the tax treatment, because the entire installment amount is eligible for deduction. So let us say your installment is 50,000, which in the first month principal is 30,000 and interest is 20,000. Now the interest portion goes to the head HP. If you remember, under head HP, you have section 24 clause B, where interest is covered, right? So when you are paying interest, so when you are paying the installment, the interest portion is already covered in the HP head. However, if you remember over there, you have the limit of 2 lakhs, another limit of 30,000 there, but today that is not applicable. Only it will be 2 lakhs only. Now, if your interest exceeds the 2 lakh limit, the excess interest is not allowed under the head HP. That you can claim under chapter 6A. But for that, we will study another section, which will be in the E series. Correct? Now, pay attention. This section is allowing you deduction for the principal portion. So in my example, out of 50,000 this month's installment, 20,000 is interest. Let it be covered under HP head. And over there, if it is excess beyond 2 lakhs, the excess you can come back and claim it under the series of E that we'll study later. This 30,000, which is for principal, is what is covered over here. Further, they have clarified that it will also include other expenses which you pay at the time of buying the house, like stamp duty, registration fee. So generally we capitalize it in the cost. So all these expenses are also eligible because they all represent the cost towards the house. So as you can see, nowhere they have written principal, but what they have said, payment is made towards cost of the house. And this is what is represented by the principal. So the principal component of your installment of housing loan is what is eligible over here. Condition is the income from such house property should be covered under the head HP. It means it should not be part of PGBP, because we have studied in HP head in some cases. It may go to the PGBP head, like you have commercial property which is given on rent and renting is your business. So that should not be the case, and would have been chargeable under that income from house property had it been not used for assessee's own residence. So means what? Even though you are not occupying it yourself, even though if you are not able to reside in that, still that income is covered under the head house property. So the basic point is it should be a residential property which is covered over here. So they have clarified from whom you can take the loan. This is again very important. You can take the loan from government or from any bank, which may also be a cooperative bank. You may have taken this housing loan from LIC, from National Housing Bank. You may have taken this from any public sector banking company, which may not be actually a bank, but different types of long-term finance companies which give you loan. Or you can even take it from your employer. So important point is even where the employee has taken loan from the employer for the purpose of buying the house, such loan is eligible for this 80C deduction. Obviously, which part? The principal part. Now, what is not available or admissible over here under 80C is following payments do not qualify: admission fee, cost of share, initial deposit, which a shareholder has to pay to the housing society. So when you buy a house, many times the house is part of some housing society, which may be registered as a company or a cooperative society. Now they charge you some admission fee. They ask you to purchase the share of that housing society. That is not covered. Only what is applicable to your house or flat, that is what is covered. Similarly, cost of any additions, alteration, renovation, or repair of the house property after the issue of completion certificate. So till your house is under construction, whatever expense you do on its renovation, repair, that is covered. But after your house is ready, that is, let us say you are presently staying in some house, now you want to do some alteration of the house. In that particular case, that amount of expenses incurred for alteration is not eligible. So even if you have taken a housing loan for that, that will not be eligible. And then any expenditure in respect of his deduction is allowable under section 24. So indirectly they are talking about interest, because for interest deduction is already allowable under section 24. So this is again a very important deduction, that is deduction towards the principal component of the housing loan. Uh, Priyanshi has a very good question. Her question is relating to the previous point, that is fees for education, right, up to two children. She's saying, is ICI fees covered in that? Good question. Let us do it this way, na? Why not you find out the answer? Now, what is the criteria? The criteria is simple. You have to see two things. First, whether ICI fits in school, college, university, education institution. Two, whether what ICI is doing is a full-time course. If you satisfy both the conditions, then the third thing you have to check in your fees, what is the tuition fee component? Check these three things, you will get the answer, and the answer is very straightforward. If anybody gets the answer, you can post it, right? Next is, you have purchased equity shares or debentures, but these are not any equity shares or debentures. They should be some specified equity shares or debentures only. Then you have purchased some specified mutual fund units. Now this is important. You have taken a FD, which is of minimum 5 years. Now FD we all know, we take an FD or we uh, get an FD from bank. So they have put a condition. So where you are depositing your money in a term deposit, which we call as FD, it should be with a scheduled bank, and it should be in accordance with the scheme which is framed by the central government. Most important, the FD should be of minimum 5 years. So if you have taken a FD of 5 or plus years, then only the amount deposited in the FD is eligible. Maximum amount is 150. Anyways, that is for entire ATC. What are scheduled banks? They have given a list. Next, you have invested in notified bonds of NABARD, or again you have taken a FD, but now this FD is with post office. So many times in rural areas there are no banks, so people do their investment by opening account in post office. Post office allows you this facility of opening a recurring deposit or FD. So if you have invested or you have put your money in the FD, and this FD is of post office, again the minimum period is 5 years. If you're a senior citizen and you have invested in the senior citizen savings scheme, this point I will explain when we deal with 80CCD deduction, because this NPS is a point connected with 80CCD. Here also you'll find a reference of 80CCD. So I'll come back to this point when we deal with 80CCD. Correct? So now these are the list of investments. Correct? Anubhav has given the answer, but Anubhav, I want the reasoning for your answer. Whether the fees paid to ICI will be eligible. You have to give me the reasoning for your answer. Rajveer says, sir, the condition for two children is same as given in salary. Yes, correct. Wherever there are two children, the condition is same. That if your first child is a single child and second time you have twins, it will be considered as two for the purpose of this section. That is, you will be getting eligible, you will be eligible for deduction for all three. But if the first time itself you have twins, then second time, even if you have a single child, three are not eligible. So the point for up to two children condition is same. First time it is a single child and then you have twins, correct? Anubhav, you have mixed two conditions. These are two different conditions. Whole time and education institution are two different conditions. So are you saying both are not satisfied? Because your sentence gives that impression. Check that. Now, I will answer question of Dhanush, who is waiting. He, sir, what will happen when I get back money or I withdraw money from these schemes? See, understand this. ATC gives you a list of different types of investment options. If you put your money there, you are getting deduction. Please understand, when you put your money there and you get back the money, it is generally getting your own money back. Generally, exceptions are always there. Generally, when you get your own money back, there is no tax on that. Tax is only on the income component. So I have put 1 lakh and I'm getting 1,20,000. So tax will be on 20,000 only. Correct. However, in some cases, now this is what we are going to study. If let us say I've invested in life insurance or I'm putting my money in provident fund, they have given some lock-in period. If I withdraw my money, let us say my life insurance which I have taken was for 20 years, but after investing within few years, I decide to stop my policy. I can withdraw the money, no problem. Same thing I can do with FD, same thing I can do with Provident Fund. Most of these things allow me to withdraw my money before the term expires. Now, this is where this particular point comes into play. So, if I withdraw my money before the minimum period given over here, now please understand, since it is your own money what you have deposited, getting back your own money is never taxable because that is never income. Please understand this. Getting back your own money cannot be taxable. See, exceptions are there, but general rule is getting back your own money cannot be taxable because it is your own money. What can be taxable is only the excess. Here, what is given that if I'm getting back my money before the minimum time period, which now we are going to study, they will ask me to reverse the deduction. So let us say I invested in life insurance by making payment of the premium. And while making payment of premium, I took deduction also. However, when we study over here, they have given some timelines. If I close my insurance policy before the given timelines and I withdraw my money, so in the year of withdrawal, what I have to do is whatever deduction I have taken in past, I will have to consider it as my income. So it is what we call in our language as withdrawal of deduction. So when you get back your money, at that time there is no tax on getting back your own money because it was your own money which you are getting back. But in this particular scenario, since at the time of depositing, I have given you the deduction, I have kept some minimum time period, which we call as lock-in period. If you withdraw your money before that lock-in period, as a punishment, what I'll do is whatever deductions I gave you in past, I will take back the deduction. Now, what is the timeline? So first is we are talking about insurance. So for insurance, if it is a single premium policy, the time limit is 2 years from the date of the policy. And in any other case, that is, it is our regular policy like how we take, which is not a single premium policy. Again, before premiums have been paid for 2 years. So in short, for life insurance, the lock-in period is 2 years. Then for unit-linked insurance, the lock-in period is 5 years. Then house property, again, the time period is 5 years. So this is where I have taken the housing loan and I'm making payment of the housing loan and I'm getting the deduction for the principal. So there they have given the timeline of 5 years. What they are saying, if you do withdrawal within this timeline, 2 years, 5 years, whatever they have given, then it shall be deemed as the income of the previous year in which you have withdrawn the amount. So what will be considered as the income of that previous year? It will be the total amount of deductions which I allowed in the previous years. So So whatever deductions you have claimed in the earlier years, that deduction will now be added to your income. This is what we call as withdrawal of deduction. Again, for investment in senior citizen savings scheme or post office, the time limit is 5 years. Anyways, for post office, the FD should be of 5 years. Now you have taken the FD of 5 years, but before 5 year period, you break the FD and get back the money. So the amount will be added back to your income, which will be called as withdrawal of deduction. Now, however, if any part of the amount relates to interest so received or withdrawn has been subjected to tax in any earlier year, such amount shall not be taxed. So now on the FD, every year you are getting interest. This interest you have already included in your total income on accrual basis. So now that interest amount which you will get at the time of breaking down your FD, that cannot be taxed now because that interest you have already taxed in the earlier years on accrual basis. So that is logical. So only the amount of deduction which was allowed, that will be added back to your income. So Dhanush, I hope you got your answer. So here they have made a summary of all these names as to what are these different names for which deduction is allowed under 80C. Correct? I hope you all have understood 80C, students. Any questions? Yes. So Priya has answered about the ICAI question. Correct. So see, basic point is your fees to ICAI is not eligible. Anubhav had also answered this. Priya is also giving the correct answer. So both your answers are correct. The main reason is because the ICAI course, that is our CA course, is not coming in the category of full-time education course. And since it is not in the full-time education course, you are not eligible for deduction. Yes, Rajvi, correct. Now, some interesting point about ATC. Now, I said ATC gives you deduction where two people have made these payments. Individually in all cases, and in majority cases HF, only in few cases HF is not eligible. Now the question is, they are making payment for whom? Like, simple example, life insurance. So life insurance payment or the premium of life insurance for securing whose life? So when you are HUF, you are making payment for ensuring the life of any of your family members. Anyways, HUF is non-living, so there is no life insurance in the name of HUF. So for HUF, the deduction will be allowed where the HUF has taken the life insurance in the name of any of its family members. Simple. Now comes the next interesting point. When you are individual, for whom have you taken this life insurance? Now, you can take life insurance for your own self, yourself. You can take for your parents. You can take for your children, your spouse, your brother, sisters. There are so many people in your family. At times, even it is your uncles because it is joint family. So your uncle, auntie, their children, that is your nephew, niece. So many people are there in your family. Now, this is where a very important point comes, which you need to remember in exams. When I'm making payment of any of these things, which is covered in 80C, I need to also check for whom I have made this payment. I'm individual, I'm eligible under 80C, but for whom I'm making this deposit, in whose name I'm making this deposit. So the rule is, pay attention. C, which is this section 80C, na? C for selfish. C for selfish. So 80C in my, I call this as illogical logics, correct? So all these things, G for God, JJs, do gulam, do ikke, all these I call as illogical logics. because some people may find it absurd. That is okay. But for me, this is a logic because it helps you remember things. So please don't say, sir, S is selfish. This is illogical logic. So even C says so. This nowadays in school they are teaching you this what you call as how you pronounce a word, something is called. So they always say C says so because many of the words starting with C has a pronunciation of so. From there, I'm drawing this logic. He C for selfish. Yes, phonetics, I think so. Not phonics, I think it is phonetics, whatever it is. So C for selfish. Now I am saying this to remember this particular very important technical point. Selfish family is my concept, which is today's world's unfortunate reality. What we call in our today's world as nucleus family, I call it as selfish family. Who is in selfish family? It is you, your spouse. So if you're a male, it is wife. If you're a female, it is your husband and your children. This is selfish family, which is the unfortunate reality of today's family. Now we don't live with our parents also. Forget about brothers, sisters, uncles. That is too far stretched. So C for selfish. Now pay attention. When I'm making payment of life insurance, example, which is covered in ATC, I will get deduction only if the life insurance policy is for my health, my life, that is for yourself, or the individual spouse, that is in my case, my wife's life insurance, or my children's life insurance. If I am also paying life insurance premium for my brother, sister's life, or my parents' life, or my uncle, aunties, or their children's life, even though I'm making payment premium, I am individual, I will not get deduction under ATC because C for selfish family. So remember this because it is not that this is going to be same in all the other sections. As you proceed in D, you'll find more people getting added to this list. So to remember, C for selfish, correct? Now, another interesting point. As we proceed, as I said in further sections, when we'll read the payment in those sections, you will find that more conditions are attached. Like, let us say in this section, I should make payment for myself, that is the individual himself or herself, spouse, children. Whether spouse, children should be dependent on me or even if they are independent, still I will get deduction. This is another important condition which you will get to read in further sections. Now, this section says nothing. It simply says spouse and children. It means whether or not my spouse and children are dependent on me, I will get deduction. So even if they are dependent, I'll get deduction for their payments. Even if they are independent, that is, they are earning, they have their own sources of income, maybe even more than me. Still, if I'm making payment of their policy premium, I will get deduction. So ATC gives me deduction for my own premium, premium of my spouse, premium of my children, and no conditions attached. They may be dependent, they may be independent. Tomorrow, even if my children become major, still I will get the deduction. Like today, my daughter is major. So even still, if I make payment for her, I will still continue to get deduction. Tomorrow, my daughter may start earning in next 1 or 2 years. Still, if I continue to make premium of a life insurance premium, I will get deduction. But this will not be the case if I make payment of a health insurance premium because it is covered in some other section with some other condition. So this technical point of ATC has to be kept in mind, and this will be kept. This you have to check for every section because every section will have different conditions. So C covers individual, spouse, children. Only this, which is selfish family, in my words. And second point, no conditions attached. They may be dependent on me, they may be independent. That is, they are not dependent on me. Still, I'm making payment, I'll get deduction. Fine, students. Any questions with ADC? Yes, beta. Krishna Shri, there is number of limit we have already seen. Acha, so we saw that limit in case of tuition fees, two children. In case of life insurance, they have not put any limit. So over there, even if I'm making payment of life insurance for more children, I'll get the deduction. So that limit of two children is only for tuition fees. Anubhav says, sir, how unfair it is. Hmm. I always have two answers. One is a very rude answer. The rude answer is that, boss, law is what the law say it is. And a more polite answer is, if you feel it is unfair, no problem. Become finance minister, change the law. It is within your power to do that, right? So Yash is saying, sir, if I take a LIC for me, my spouse. So, Yash, so you have a spouse. Good. Glad to know this. So Yash says, sir, if I take LIC for me, my spouse, who is independent, and same, my spouse takes LIC for me and herself, and both are independent. This is what I'm getting. Do both of us will get deduction for having two LICs? Yes, beta. Very good point. So even if you have multiple LICs, there is no restriction that there should be one LIC. So there can be multiple LICs. Anyways, that is why they have the limit of 1,50,000. So all these payments, entire ATC list combined, all these payments, life insurance, deferred annuity plan, then some notified mutual fund units, then two children tuition fees, then housing, you add up all this list, the total cannot exceed 150. So within LIC, you may have multiple plans. Some you are paying, some your spouse is paying. Whoever is paying will get the deduction as per the conditions. And it may be any number of plans, you add up. Anyways, 1,50,000 limit will take care. Sahil Kumar is asking, sir, if I'm making payment for my father's LIC, then whether I'll be eligible. But now I think you should be getting the answer yourself. I said C for selfish family, which means payment only for three persons, yourself, your spouse, or your children. Payment for any other, ATC does not allow deduction. Fine. Perfect. Next section. C, C, C. What is this? If you watch television, movies, different programs, many times between the serials, between the movies, you get advertisements. And there are advertisements where they talk about something called as retirement solutions. Now, I like one of the ads a lot. In fact, I watch ads from a different perspective. I don't ad, I don't watch ad from the perspective of what product they are selling or who actor or cricketer is in the ad. I try to watch the ad from the logic behind making the ad. That is, what is the concept line of that ad, or what emotions they are pricking. I'm using the word pricking. So when you see these retirement solution ads, what is basically retirement solution? Today you are earning, you are having money, so invest. So that when you retire, LIC or any other insurance company, wherever you have taken the policy, will give you something like a fixed amount every month, every year, which will be something like a pension. Though you cannot call it as a pension because they are not your employers, but this is what is the scheme they have. This is what they call as retirement solution. So it is one of the insurance companies policies plans. We cannot call it as life insurance because over there it is not exactly life insurance, though it has component of life insurance. So it is called as they call in their language as retirement solutions. Now here I like the ad of ICICI Prudentials a lot. You can go and check on YouTube later on, where they are hitting on uh, very subtle emotion that after you retire, after you are aged, you should not be dependent on your children for money. So the tagline is "Na sar jhuka tha kabhi, na sar jhukega kabhi." So they even sing this during the ad, and that is a beautiful ad. So that ad is always there in my mind when I'm studying this section 80CCC. And that is how I even remember the section number, because ICICI, if you remove the I's, what is left is CCC. So this is how also I can remember this section. So this section is basically giving me the deduction plan of LIC or any other insurer, And this is the plan where I will be receiving pension from the fund which these people have set up. Now, this fund is nothing but whatever premium I'm paying during my earning phase of my life, that is getting invested in some fund. And after my retirement, they are giving me a fixed amount either every month, every year, which is called in their language as pension, though technically it is not pension because they are not my employers. Now, this contribution to this fund, this type of retirement solution, if it is by life insurance company or any other insurer like ICICI, Bajaj, all these insurance companies who are registered with the IRDA, I will be eligible for this deduction. Again, interestingly, the limit for deduction under this section also is 1,50,000. So the maximum permissible deduction for this section is also 1,50,000. And interestingly, further, another section 80CCE says that the combined deduction of these three sections is also 150. So we read previous section 80C, it said limit is of entire 80C list, total of all items in 80C is 150. Now this section 80CCC says its limit is 150. We are going to read the other section 80CCD, there also the limit is 150. But collectively, the limit of these three sections together is also 150. So effectively, even though individual limits are kept to these three sections, but because of 80CCE, your effective limit for all these three sections total is also 150. I hope this point is clear. So individual section limit is 150. So where you are having only one of the sections, still you can take 150 as the limit. And where you are investing in multiple things, few falling in ATC or even this or even the next one, the total limit of these three sections together is also 150. Correct? Now answering the question of Dhanush. Today I'm investing in these plans, I'm getting this deduction. Tomorrow, after a particular age, I will be getting some regular amount from these plans, what they call as pension. What will be the tax treatment when I'll be getting the money from these plans, which they call as pension? So what is given? Where any amount standing to the credit of the assessee in the fund, in respect of which a deduction has been allowed, together with the interest bonus accrued or credited to the assessee's account, is received by the assessee or his nominee on account of the surrender of the annuity plan in any previous year, or as a pension, that is a regular amount that they are going to give, which is their plan from the annuity plan, such amount will be deemed to be the income of the assessee or the nominee in the period in which such withdrawal is made or the pension is received, and it will be chargeable to tax as the income. So what is the point? So when I will be getting my money back, I will be required to pay tax, or it will be considered as my income. See, Priya, when we are talking about subscription to share debentures, only the amount which I have invested in the eligible share debentures is eligible for deduction in ATC. Whatever dividends you are going to get, that is an income which will be taxed under other sources. It cannot come in ATC, because dividend is income, it is not your investment. Fine. Priyanshi, uh, Priyanshi has a good analogy. She's saying it is like our marks. 40 is minimum, but aggregate should be 150 out of 300, which means 50 per subject. But here it is slightly different. It need not be 50 per subject and need not be even 150, because 150 has to be aggregate of all three subjects. Here it can be even in one subject or in one section that you take the entire 150 and the other two you don't take anything. So Priyanshi, I will not agree to what you have drawn the analogy, but fine, if that helps you remember the point, you can keep it mind that way. Now coming to the third interesting section 80CCD, Cafe Coffee Day. Now, what does this section deals with? Again, it deals with pension scheme. Now you'll say, sir, above section 80CCC was also pension plan only, pension scheme only. Yes. What is the difference? The difference is above pension plan or scheme was of insurance companies like LIC, ICAI, Prudential, or Bajaj Insurance, etc. This is the pension scheme, pension plan of central government. In fact, there is a particular name to this plan. It is called as today as the Atal Pension Yojana, named after our respected past Prime Minister Shri Atal Bihari Vajpayee ji. So, where you are contributing in the pension plan set up by the central government, which is also called as NPS, National Pension Scheme. So there are two names to this. The particular name of this plan is Atal Pension Yojana in Hindi, and in English they are calling it as National Pension Scheme. So where you are investing here, you get deduction under 80CCD. Now, what is the illogical logic? So this is basically for giving you pension so that after your retirement, you can enjoy your remaining life without any hassle or worrying of income. And you can enjoy it in CCD where you can just chill out, hang out, and you should have sufficient money at the time of retirement. You should get a regular amount. That is what this deduction is about. So 80CCC, CCD both gives you deduction for contributing today to the pension plan. The only difference is CCC is of private insurers, including LIC. CCD is of government, central government. Now, originally, when this scheme was started, if I'm not wrong, somewhere in 2004, if I'm not wrong, this scheme was started. At that time, this scheme covered only the employees of central government. Then the scheme extended to employees of state government. Then it was extended to all employees. And today it is extended even to you and me, that is self-employed individuals. In short, even though it is a central government pension scheme, anybody can participate in this. Government employees, private employees, and even those who are not employees, that is, who are having their own business or having their own sources of income. Now, the main point. The main point is that where you are investing in this scheme, first, like myself, I'm not employee with anyone. So I will invest it only on my own account because there is no other person who will be investing on my behalf. That is one possibility. Second, the scheme can be taken up by my employers also. So if my employers take up the scheme, so in this scheme, two persons will be investing. Some part will be contributed by my employer, like how they do in Provident Fund. They will also invest in pension scheme. In fact, why this pension scheme or this concept was brought in? Because the government found that they are spending a huge amount in giving pensions to their employees after their retirement, which is adding too much to the cost of the government. So they brought in this concept whereby during the course of employment, you will be contributing to a special fund created and maintained by government only. But now this will be a special fund where every month government is contributing some portion, you are contributing some portion. So this becomes a huge amount of fund. And after your retirement, government does not have to bother because your pension will be coming from this fund. So that is where the government's burden on their exchequer is reduced. This was the logic of behind the scheme, and then later on it was extended to even private employers. So now where private employers wish to ensure that their employees get pension, they may also participate in this particular scheme. They may also get themselves registered as employer in the scheme, and then they will be opening account for each of their employees, and every month some part will be deducted from your salary as your contribution to this pension plan. Some part the employer would be contributing. Generally it is equal. However, you always have a scope of investing any amount because it is your money and this investment is also yours. Obviously employer will keep his contribution limited to what he has promised in the salary contract, but you can always extend your contribution beyond that minimum amount. So let us say employer is contributing every month 10%, you can contribute 10, 12, 15. Your choice, you have to simply inform the employer so that that much deduction the employer will be making out of your salary and every month putting in this particular scheme. Now, the point is This scheme is so special that this is the only scheme where in the entire Income Tax Act, entire Chapter 6, this is the only section which gives you deduction for both contributions. See, normally in all other sections, including ATC, CCC, and all other sections, where employer is also contributing for you and you are anyways contributing, which is called as employees contribution and employers contribution, you always get deduction only for your contribution. Like in Provident Fund or in any other scheme where both are contributing, you will get deduction only for your contribution because that is your investment. Whatever employer is doing is not going out of your pocket. In fact, that is an added benefit because employer is paying something out of his pocket and it will be added to your fund, which you'll get in the future. So you get deduction only for your contribution, which we call as employees contribution. For all other schemes, all other plans, provident fund, everything. However, only for this 80CCD, which is National Pension Scheme of central government, where your employer is also contributing, the tax effect is whatever your employer is contributing is first added to your salary as your salary income. So employer contributing, anyways, it is your benefit from employer. So it is part of your salary income fully. And then your contribution and employer's contribution, both contributions are allowed as deduction under 80CCD up to the limit what we are going to study. Now, what is this limit up to which you get deduction? That is interesting. So, where we are talking about your contribution, and let us say you are not an employee, like a person like me. Now, for me, a person like me who is a self-employed person, nobody else is contributing. It is only me who is contributing. So the limit for my deduction is 20% of my gross total income of that year. So whatever I have contributed to this particular scheme, I am eligible to take deduction up to 20%. But when it comes to those people where they are also contributing and their employer is also contributing, it means they are contributing as an employee. So for them, the deduction is up to 10% of the salary. Now, why it is 10% for them and 20% for me? Because for them, they will get this deduction again. As I said, this is the only section which is giving deduction for employer's contribution also, whereby they will be getting the contribution which is made by their employer. Now, their employer can be central government, now even state government or even private. So they will be eligible to get deduction for their employer's contribution also. And here remaining 10% can be used. Now, interestingly, where your employer is a central or state government, now the limit of deduction, which was earlier 10% of salary, has been increased to 14% of salary. And in case where your employer is a private employer, the limit is 10% of salary, right? Now, interestingly, if you remember, when we were starting the deduction in that diagram, we studied that all deductions, 99% of them are allowed only in the old scheme. However, there are three deductions which are allowed in the new scheme. Out of those three, the first two deductions, entire deduction is not allowed. Only one part of the deduction is allowed, which was, if you remember, subsection 2. And right now what we are studying is subsection 2 only of this section. See, there is subsection 1, there is subsection 1B, which we are going to study later. 1 we have already seen, that is your employee's contribution. 1B we are going to study later. Right now we are on subsection 2, which is your employer's contribution to this scheme. So when employer is contributing to this scheme, and this is the only section where you are getting deduction for employer's contribution, and one more section 80CCH, which will be later after this, you are getting deduction for employer's contribution, where if employer is central state government, it is 14%, where it is private employer, it is 10%. And most important, you are getting this benefit even under the new scheme. What is important is that they are saying under the new scheme, you will get deduction for this section, only the employer's portion, and that will be allowed up to 14% of salary, which means for both government employees also and for private employees also. So in short, in the old scheme, there is one disadvantage that for private employees, the limit for deduction on account of employer's contribution is limited to 10%. But if they are in the new scheme, and this section gives deduction even under the new scheme for the employer's contribution, and over there, even for private employees, the employer's contribution up to 14% is eligible. So this is a very interesting part. Now we were talking about deduction. So deduction you get under three parts. First, your own contribution 80CCD, subsection 1. Second part, subsection 2, employer's contribution. Third part, deduction under 80CCD, subsection 1B. Now what is this 1B giving deduction for? Subsection 1 gave for your contribution, that is employees. Subsection 2 gave for employers. What is this 1B? This 1B is giving deduction again for your contribution. It is giving deduction again for your contribution. But you will say, sir, but my contribution, I'm already getting deduction under subsection 1. Yes, but if you remember, we had studied above, there was a maximum limit of three sections, 80C, CCC, and this section CCD subsection 1. That is your contribution. So 80C, anyways, ATC, CCC, all other sections cover only your contribution. So these three sections combined, C, CCC, CCD, and all these three combined your contribution. The total limit of these three sections combined was 1,50,000. Now let us say you are exhausting this 1,50,000 in the first two sections itself. Then practically you not get benefit under this section. But this section the government wants to promote because this is the investment of central government itself. It is the pension fund of central government itself. So what they have said, sorry. So what they have said here that you are getting deduction under subsection 1 for your contribution, but it is clubbed with the other two sections and total limit is 150. So let me allow you extra limit of more 50,000. So it is again dealing with your own contribution. So whatever is your contribution to this scheme, you can claim additional deduction up to 50,000. In other words, now these three sections combined, the total limit of deduction becomes 2 lakhs. How? Original limit, these three sections combined was 50,000. Yes. And in this three, for the third section, 80CCD, what we are presently discussing, that is central government's pension plan, for your contribution, you can claim extra deduction of further 50,000. So effectively, these three sections combined for your contribution, you can take deduction up to 2 lakhs. So first basic deduction 150 plus additional deduction 50. So total deduction 2 lakhs. And interestingly, you also get deduction for employer's contribution, which we studied in the next subsection 2. Importantly, that is not covered in the limit of 150. So 150 limit, which we studied above, is only for first three sections, your contribution. Anyways, first two sections has only your contribution. This section even has employer's contribution that you keep aside. So for your contribution in these three sections, the basic limit is 150. Plus you get additional limit for your contribution only for this section of 50. So total limit for all these three sections for your contribution is 2 lakhs. And besides that, you also get deduction for your employer's contribution, which is not in the overall limit of 150 and 50. So besides this 150 plus 50, you also get deduction for employer's contribution. Now remember one thing, there are two limits parallelly. First, if you remember, already there was a limit of 10% of your salary for your contribution. So your contribution should not exceed 10% of salary. That limit is there. Plus the limit of 150, which is common, and additional 50. So you have to satisfy both limits, 10% of salary plus the monetary limit of 150 and 50. But when you come to employer's contribution deduction, There is no monetary limit. There is only one limit, which is of percentage, which we saw, which is 14 and 10. And in case of new scheme, it is total 14. So this is how you get deduction under 80CCD, right? So students, that is all from my side for today. We'll stop over here. I know this may not be so confidently clear to you because this section is slightly tricky, but no problem. I'm ending with this section so that you also have some time to reread it, read further sections also, and come at least up to 80G series. You read all the section, that much we will expect to complete in the next class. So you read all these sections from 80C to 80G again. We will revise all these sections in the next class and we'll proceed further. Fine. So thank you very much, everyone. I hope you all understood things. What is not clear, requesting you to read, and we will again discuss, clear all your doubts, and we will proceed in the next class. So thank you all. Take care. Good night. And most important, be in touch with your studies. Thank you. Yes, sir. Done from my side. Good night, Manishi.